Hefe, it has been too long. I feel like we haven't recorded in forever together. We've had some new guests on the pod, so good to be back with the two of us. How you been?
Yeah, man, I've been doing great. Jefe, that's Spanish for boss, right?
It is, but it's close to Jeff, so it
Right.
kind of works with both, I guess. I
Yeah,
don't
I think it's got two uses
know.
there. Hey, man, it's been going good. Yeah, we had a good episode with Jamie and John Jarvis, and that sounds like you had a guest. That was
Yeah,
a pretty
yeah,
nice
Susanna
episode too.
Barton.
Yeah,
Yeah,
yeah.
yeah. So good to
Well,
get
there's not
back to
really
the
a lot
OGs,
been
you
keeping
know?
me busy the last few weeks.
You
Really
know, the
nothing going
market's
on.
been slow. Like I haven't heard anything in the news that's
Yeah, I've just
happening.
been
So
snoozing the whole time. Nothing really to keep track of or pay attention to and monitor. Right.
and it was funny because we had these guests lined up, and I was like, "Oh my God, there's so much stuff we want to talk about. Like, it'd be great to get the pod going." But nonetheless, we'll talk about it all today. Get into all the juicy tariff talk, the trade talk, the economy, everything everyone wants to hear. I think that's what everyone's looking for, and certainly gonna hit it all. But we always like to start with an icebreaker. Last week we did near death experiences, and you weren't on the pod, and I was told through the grapevine you might have one to share with us today.
Yeah, well, when you live on the edge like I do, you're bound to have some near death experiences. I'm a bit of a thrill seeker. You know this about me, Arish. And
Oh yeah.
so one time I was out hiking in Arkansas. This was when I was in college. I was, I think, finishing up my freshman year in college, and I was hiking on this bluff right alongside this river in Arkansas, kind of right around Mountain Home, Arkansas. And I remember I kind of at this bluff, and I'm near the top of it, and there's like this part that kind of protrudes out the side, and then there's like this 8 to 10 foot like kind of slope or wall, whatever, to up to the very top. And I'm like, you know what, I'm gonna climb that. Like, I'm not gonna climb any of this other stuff, it's way too dangerous, obviously, but I'm gonna climb this like 10 foot section that's a part of the other section that's probably 200-300 feet high. And I'm like, all right, where am I going to try to go about this? And I said, you know what, just in case, because I love a good just in case. I love good hedge and risk management. I said, I'm going to do it in front of this lone tree at the edge of the cliff, just in case something happens and I have something to fall back into.
Smart.
And guess what happens?
Something happened.
So I slipped, I like missed my fall, and I'm like, oh, doing this like in the back. And then this tree stopped me from going over the edge. So, yeah, that was definitely one of those where I kind of looked back and I was like, wow, okay, that was a close one.
So if that tree wasn't there, how far were you gonna fall?
200-300 feet drop into the
Oh,
water below. Yeah,
holy!
because I'm just having fun. I'm like, listen, I'm not going to climb up the whole thing, but this little 8 foot section, I've climbed rocks and like done stuff like that before, no worries. And like, just kind of slipped, kind of lost my balance, was falling back, and I was like falling back to the edge where this one tree was. And it wasn't a large tree; it was like 5-6 feet high tree, and it caught me.
Jeez, you're practically free soloing at that point.
Yeah, man. I mean, why
That's
not?
crazy.
The ironic part is I'm afraid of heights, but I love to like challenge that. I love
Yeah.
to kind of like make myself get over it by putting myself in those situations. So
Yeah,
yeah, that was fun.
I was actually in Bali this last summer, 2024, and we hiked this volcano, right? And insane experience. The hike started. They picked us up at 11 p.m. for a hike for the sunrise. So you drive out an hour. We started actually hiking at midnight. And the reason why you start so early is they have like blue fire in the volcano, and you can only see it before there's any light. So you have to get to that part by 4 a.m. And it's like a 4-hour hike. So we go in, do all of that, and then after you see that, then you hike up to the ridge of the volcano, and then that's where you see sunrise. It's like one of the most beautiful things I've ever seen. And as we're like hiking up, you have a guide who's like leading you, and he was saying, so there's this like one tree that was like a famous place to take a picture on. Like you sit on the tree, and it's like right over the edge. It's like a very famous like place to take a picture, apparently. Apparently there was a tourist from China who's in her 20s. She wore a dress for some reason on this day when she did a hike. And she went to go take the picture, and the dress got caught under her feet. She tripped on it and she fell out, like she died. Yeah. So I hate
Fell into
to,
the volcano?
yeah. Well, like it's not like straight into the volcano, but like she fell like a couple 100 feet onto like more rock and like,
Yeah.
and he was telling us all the tour guides had to go in, go get the body. Like it was mangled, but like they had to go and get the body and take it out. And it's not an easy hike. So like carrying a body up and out of there,
Oh man.
they can't like heli in, like
Yeah.
it's not.
I think,
So
yeah, there's, I always say you have to respect the risk of Mother Nature and the environment
yeah.
around you. And, ouch, dude. Yeah, that sucks. That's really
Yeah,
sad.
yeah. No, it is. It is. So hey, didn't want to bring a bummer, but the tree catching you, it reminded me of that
I,
story.
I mean,
So
the one thing about that is I just remember having this thought, like, just in case,
yeah.
and I think I've always been a guy that evaluates trade-offs and risk reward and those kind of things. And I think that's kind of funny how even at a young age I was thinking that way. And that I bring a lot of that to that when I manage portfolios. You always need that just in case. I think that's why we use diversification. We've talked about that, but it's like
Oh yeah.
that's like the one thing that's like, hey, if something goes wrong, what's going to happen? Well, have a just in case for
There
if
you go.
something goes wrong. And yeah, so glad
Well,
I did that. Of course,
yeah.
I wouldn't have known for very long if I hadn't. So that my grandpa used to say, it's that sudden stop at the end that gets you.
Well, that's a perfect segue in terms of what we're talking about. We've definitely seen some risk in the market. So let's run through the intro and let's get into it.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and to help individuals create the roadmap for their financial future. Calls are pre-screened and the content was pre-recorded. Please note that the content presented is for educational purposes only. We encourage you to consult a financial advisor or conduct your own due diligence before making any investment decisions. All information provided is believed to be reliable but is not guaranteed for accuracy or completeness. This presentation does not constitute investment, legal, or tax advice, nor an offer to buy or sell any security or insurance product. It also does not endorse any third party or their views. All examples are hypothetical and for illustrative purposes only.
All right. Well, we promised tariff talk and trade talk, economy. What do you want to start with? You lead us today, Jeff.
I think let's just like start with where we've been. Okay, so like the markets have been really volatile, not just equity markets, which everyone follows, but also bond markets, interest rates, segments of the bond markets have been especially volatile. So like I have like some numbers here, right? So this is all as of the close on May 15th, 2025. So the S&P 500 year to date is up 1%. That's at one point it was down 19% at the low on April 8th.
Down from the highs or down year
from
to
the
date?
highs.
Okay.
Yeah, down from the highs. We were up around 2.5–3% year to date, I think, at the highs, and then we dropped 19% to April 8th. This was kind of the Monday after the Liberation Day tariffs, right, or the Day of Reckoning Day tariffs, as I say. Since April 8th, since that bottom, the S&P is up 19%. Okay, so we basically round tripped. We had a lot of volatility in the markets, and we basically round tripped, and now we're almost back up to where we were. I think what's interesting is a lot of other parts of the market are up 19% from the lows. So we talk a lot about mid caps and small caps. Those are up 19% from the lows. So it's been a really broad-based rally. International markets are also up 19% from the lows, and they're having a good year because of the dollar depreciation. So I think that's interesting. If you look at some of the kind of the hot stocks in 2024, those sold off quite a bit. Going into this year, a lot of the AI names, the chip names, the electrification names, those are up 40–50%, some of them from the lows, right? So we've had quite a bit of volatility. I think something else that's interesting is bonds have done pretty well this year. Interest rates were extremely volatile. So rates fell from January 1st to April 4th, about 50 basis points if you look at the 2-year, the 5-year, and the 10-year treasury. And so that really helps bond prices. And so the ag at one point was up 3.6% in early April, kind of as all this volatility was hitting its peak. And then, of course, as the 90-day pause has come back in, rates have moved up a little bit, but still the ag is up 1.5%, right? Throughout this, credit spreads too have been extremely volatile. So credit spreads, think of this for people that are not familiar. These are kind of like riskier bonds in the market. The safest bonds in the market are treasuries, but then you have corporate bonds, some of which are going to pay you back, so they're pretty highly rated, or investment grade bonds, some of which maybe you're not sure. You require additional compensation to take that risk, and we call that additional compensation credit spreads. And they basically follow stocks, right? When stocks are freaking out, you typically see corporate bonds also freaking out and those credit spreads widening. And that's exactly what we saw this year as well. Credit spreads actually rose over 100 basis points in high yield, and they went from the 99th percentile in terms of valuation. So the spreads were at the most narrow they've been over 99% of the time. It went from that to the 50th percentile in basically just a couple of weeks, with credit spreads going nuts. So suffice it to say that all this tariff conversation really caused a lot of volatility. And I think the reason why the market is reacting so favorably now is because we have this 90-day pause, and not just a 90-day pause, but it seems like a willingness from the administration to negotiate trade deals. And I think at first that was questioned because it seemed like they were more intent on trade deficits or fentanyl or some other measures that they were saying. And now it seems like, okay, we're kind of back to the negotiating table. They see the effect that this is having on markets, and now they're starting to pull that back and work the other way. And that's a good direction to go.
Yeah, for sure. So I want to get some clarification and explain a couple of the points you just made there, and kind of dive a little bit deeper. So you mentioned kind of bonds. Where with yields did we start the year versus where are we at now? I guess choose the 10-year or something.
All right, so the 2-year note was at 4.25 on January 1st. The 10-year note was at 4.5%.
Okay.
Now the 10-year note is at 4.45%. So it's down. It's still a
Slightly
little lower
down
than it was at the beginning of the year, right? But the 10-year fell 57 basis points from January 1st to April 4th, and then regained 52 basis points.
So it's in the threes for a second. It's high threes.
It touched 4. Yeah, it touched 4.
Okay.
Very briefly. 4.01 is the low close is what I see here. But I think intraday it did go below 4.
Gotcha.
Yes. And now, we're kind of back up to 4.5 on the 10-year, which is pretty close to probably fair value for a lot of people.
So I wanted to bring back another point I know we've made probably a couple times now through the pod. So our most loyal listeners know this by heart, obviously. But I think it's you kind of mentioned it, but just to explain it. But as rates go down, you mentioned kind of bonds do well, and that's because of the inverse correlation between yields and the price of bonds. So you can think of it as you put $10,000 in the 10-year at the beginning of the year at 4.5%. And then when they drop to 4%, the value of your bond is more, because if someone has $10,000 and they want to go buy a bond from the government, they're only able to get 4% at that point, but you have that 4.5% locked in. So then they can buy it from you, but obviously you're not going to sell it to them at 10,000. You'll sell it for them at a premium there. So that inverse correlation between rates and the value is really, really important. And especially at these higher yields, makes a lot of sense to have in portfolios, and is why we've added kind of some more allocation there, and is an important place to start kind of our discussion today about.
Yeah, I think that's kind of the primary reason that you see bonds acting as a nice diversification to bonds, is because when economic activity is expected to be decreasing or growth is expected to be falling, that means there's less demand for money, there's less demand for investment, which means interest rates fall, which means bond prices go up. But it also usually means on the equity side of your portfolio, earnings expectations are declining, maybe valuations are declining, and so stock prices are going down, but interest rates are falling, so bond prices are going up. And then on the other side of that, bonds are very unique from stocks in that stocks, the main portion of return from a stock is the price appreciation and not the dividend, versus the bond, it's the opposite. The main portion of return for a bond is the income component versus the price, right? And so that's also what we're seeing is with yields staying high, with the Fed kind of on hold for the time being, maybe over the next few months, we're actually getting good yield on bonds, and the prices can go up if those yields fall due to economic weakness, right? And we certainly saw that play out in April. I think one more thing is a lot of people have talked about the death of the 60-40 and whether correlations between bonds and stocks are ever going to go back to inversely correlated, or are bonds really a diversifier for stocks? And I've been very adamant, yes, bonds are a diversifier for stocks. People have not just been recognizing why interest rates move up and down. If interest rates move up because of inflation, no, bonds are not a good diversifier. But if we have an economic growth scare, yields will fall and bonds will do well. And that's exactly what we've seen, right? So it's really the type of environment we're in that dictates how these assets behave.
So, and that's a great point. It's a perfect segue to the next thing I wanted to talk about was you mentioned that economic uncertainty, bond price or bond yields will go down. I think whenever we see volatility, we've seen all this stuff in the news about tariff tantrum, blah, blah, blah. Everyone first thinks of equities. The stock market. That's what everyone follows. Okay, stocks are going to go down. There's economic uncertainty. Can you kind of explain why rates go down on the bond market, or how that has an effect on the bond market?
Yeah, I mean, really, it's people trying to evaluate the level of interest rates based on, number one is Fed policy. That's kind of what dictates short-term interest rates. And then number two, on the long side of the curve, like 10-year rates, 20-year, 30-year rates, it's the outlook for inflation and growth, right? And so as, if you think about it, if you expect over the next 10-year period, growth is going to be pretty good, then you would expect that there's going to be higher demand for a finite amount of capital to invest in certain projects to capitalize on that growth, right? The better growth is going to be, or the better it's expected to be, the more people are willing to invest in the economy, which pulls from the financial capital that we have, which the price of financial capital is interest rate. So it causes the interest rate to rise. The opposite effect happens if growth is expected to decline or inflation is expected to decline. You don't have as much inflation, bondholders don't expect as much compensation to cover for the loss of their purchasing power. Right. And so all of these things are interacting. And so when you see growth start to fall, then it's a less demand for that finite pool of financial resources. And so the price of that pool of financial resources, interest rates fall. So it's really everything in this economy is supply and demand. Every single price of a financial asset is the present value of future cash flows. Right. And it's so funny how so many things in our world boil down to those two things.
For sure. And I guess, so like I've kind of always thought about it, and I'm curious on your thoughts here on how much you would attribute it to when there's economic uncertainty. Like if it's projected to see, okay, we're going to have a recession or economic uncertainty, how much would you attribute interest rates falling to, okay, because the economy's not going to be doing as well, there's a higher likelihood that the Federal Reserve is going to have to come in and bring interest rates down to then stimulate the economy. And then the bond market is predicting that ahead of time, and that's why it's coming down. Would you say that also has an effect on it, or is that my dumb advisor brain?
I think it's like all we ever see is the net effect of multiple variables interacting. And so it's really tough, right? So all of that, it's well, the Fed's going to cut rates. So that means short-term rates are lower, which means as you compound those rates across the curve into time, you have a lower kind of average rate for longer term bonds. But yes, to your point, could it stimulate activity? Well, maybe, but how much of that is going to offset the decline that we were already expecting that's causing the Fed to cut, right? And usually that's kind of it's like the Fed cutting rates is probably never going to offset that initial economic weakness that's expected to cause the Fed to cut, right? And that's, the Fed cutting, a lot of time people call it like pushing on a rope, or leading horse to the water, but you can't make them drink. You can cut rates all you want to stimulate the economy, but if no one is confident enough to go buy a car or buy a home or start a business or take out a loan to invest in new capital, then you're not going to get that economic activity. So you can lead a horse to the water, but you can't make them drink, right? And so I think we're kind of, it's just a really interesting conversation, but overall, I mean, interest rates are about the supply and demand of money. And the Fed definitely controls that to a large extent, but they can't control it for some longer term interest rates that, I think are in question. But anyway, we've seen interest rates completely round trip, and we've seen the corporate spreads kind of show, just like equity markets, they've kind of priced away some of that weakness and some of that volatility, but not quite, to the highs.
Well, I know we just went down a deep rabbit hole, and you have a lot of different stuff. I know you mentioned some juicy graphs. So what else you got?
Okay, so I have a couple of graphs for you. This is gonna be really fun. So the first one is just some stats for you about how we're already seeing kind of the effects of tariffs on some data series, right? And so I'm going to preface this by saying we have two types of data that we look at: soft data and hard data. Hard data is like GDP, inflation, industrial production. Like we went and got the receipts and we see exactly what production is, right? So really, really reliable. Soft data is like surveys and asking people, how much do you want to spend? Do you intend to, buy this or order this new good or invest in this capacity, right? And then, the hard data would obviously did they do that? Did they follow through with that spending, right? So what we've seen from the tariffs is that all the soft data has completely deteriorated and declined. People are saying that they don't feel good, they're worried, they're pessimistic, but the hard data is still showing decent levels of spending. But I think what's interesting, if we dig down into the soft data, we're already seeing the effects of tariffs, right? So here's an interesting stat. The ISM Manufacturing Purchasing Managers Index. So this is the Institute of Supply Management. They conduct a survey of manufacturing and services businesses. This one in particular is on manufacturing businesses only. And I'm looking at the percentage of respondents that are reporting higher prices. Okay. In January of 2025, that was 12%. In in November of 2024, that was 12%. 3 months later, February 2025, it was 31%. And in April of 2025, it was 49%. Okay? Service PMI, I went and looked at the services index. Those seeing higher prices went from 19% November of last year to 40% in April of this year. At the same time, if you look at the component of the ISM Manufacturing PMI that tracks new orders, it declined from expansionary territory above 50 to contractionary territory below 50, meaning that people are reporting less orders for new goods. So what do we have? We have the managers of manufacturing facilities in the US saying that here's what they're reporting: lower orders for new goods and higher prices for those goods. What does that translate to in an economy? That means we're getting less stuff and we're paying more for it. And that's what tariffs do. We are importing stuff from the rest of the world. We're buying things from the rest, and we'll talk about why we do that. And that costs a certain amount. And when tariffs increase the price for that, what do people do? They buy less of it. That's the law of demand. And that's why the demand curve is downward sloping. And if you're buying less of it, you're getting less of it, but you're also paying a higher price. And so we're actually losing on both sides of the token. In an economy, you want to produce more stuff and you want to do it at less cost. We're moving in the opposite direction on both fronts. And this burst graph shows that. It shows that those reporting higher prices is spiking, and those reporting increases in new orders is falling.
So was this so I don't have the graph in front of me, and we'll have it on the screen on the YouTube and everything. But was that soft data or hard data?
So that's soft. That's survey data. Yeah, and that goes from it was updated in April of 2025. So we do have a recent read from April that was released in early May.
Got it. And as soon as you started talking about that in survey data, I pulled up a graph on my end from JP Morgan Guide to the Markets. Have you seen the consumer confidence in the stock market graph? So I had a presentation at my networking group, and I thought this was really interesting in terms of where the consumer sentiment index is, and then the subsequent 12-month returns of the S&P 500. And right now we're at this really, really low period here on the consumer sentiment index, at this 52.2. So you can see this huge drop in consumer sentiment index compared to all of these other periods where October 1990, we were at a really low period, March 2003, November 2008. And you see the subsequent S&P return after that, after each of these, are fairly large. When we look at a 12-month return, I think it comes back to that Warren Buffett quote of being able to be greedy when others are fearful. And I know our clients and investors over this period of volatility who were able to stay in the market, or even if they had extra capital, they were able to invest when we had that pullback. They were quickly compensated. Who knows what the next month, 3 months, 6 months will be. But I think that stays true over time, is being able to stay in the market over long periods of time, even when things are scary, pays off in the long run.
Yeah, I mean, we talked about how the S&P is done a round trip, since its volatility. And I think what's interesting is the average drawdown for any given calendar year in the S&P is 14%. But we had a 19% drawdown, and we had a 19% drawdown in 1998 before the market went on to post another year of back-to-back-to-back 20% plus returns. Does this sound familiar? We had 20% plus back-to-back years the last 2 years, right? And so I think, and by the way, that was leading up to the internet bubble, because we had this new groundbreaking technology that was supposed to affect everything, which ended up being true, right? And so I do see some parallels, and I think this is interesting. We certainly, didn't make any major changes in the portfolios that we manage, and we advise our clients, sit on your hands. This is way too much uncertainty, and we certainly don't see this persisting because at the end of the day, trade is good and tariffs are not. And unless they're used as kind of a temporary means to some kind of other end, that's one thing. But if they're kind of put in place permanently, what we've already talked about it. You get less stuff for higher prices. That's just not a winning combination. So there's kind of another angle I want to take with this.
Yeah,
Arish.
please.
And so this is my second graph, and I'm going to lead up to this. Since January 31st of 1983,
Okay.
U.S. manufacturing output has changed by what percent? What would you guess?
You're saying it's increased or decreased?
I'm asking you.
Or
That would
okay.
be, up or down, and what number, what magnitude?
I mean, that was the industrial. So I mean, it's definitely, I would assume, decreased a lot. I'll say it's 40% lower than it was in
All right,
the 80s.
minus 40%. I'll write that down. Okay. So let's go back to some basic economics before I answer that question. A lot of people think of the economy as a means of like creating a lot of jobs or stimulating demand so for people to buy stuff. That's not at all how economists see the economy. The economists see the economy as a collection of resources that can be used to create goods and services. But those resources that we have are finite. They're limited in number, but the amount of goods and services that we want to produce for everyone is infinite. It's unlimited. So we have to allocate that finite pool of resources to best maximize the production of those goods and services. So what are those resources, those economic resources? These are called factors of production economics. They're labor, so like your workers. Capital, this isn't money, this is like equipment and tools, things that workers use to make themselves more productive. This is land, which includes like water and oil and natural resources, and entrepreneurship. That's the last one. And that basically is, innovators and managers that can come in and combine these resources and make them more effective. The sum of the parts the whole is greater than the sum of the parts, right? So everything that we make has to use some kind of combination of those resources. And these resources across countries vary, right? Some countries have a higher quantity of resources. Some other countries have a higher quality of resources. Certainly the differences in labor quality is one that people talk about, or the differences in equipment and tools, right? And so what's interesting is the cost of anything, if you look at it as a pool of resources, the cost of making any one good or service really should be measured in what could I have used this resource to make instead, right? It's that opportunity cost, right? I used 2 workers to build a car. Could those 2 workers have also built half a house? And therefore the cost of 1 car is half a house? Yeah. And that's kind of the way to think about it is, what does this really cost in the number of the resources that we're using to build it versus what those resources could have built? And so this kind of goes into this theory of comparative advantage. This is an idea coined by David Ricardo in 1817. David Ricardo he studied under Adam Smith, who wrote The Wealth of Nations, right? Very famous economist. And he basically said someone has a comparative advantage if you can use less resources to create the same amount of goods, or you're giving up less in that trade-off between resources when you produce a certain good. And you're doing that better than other countries, right? And then along the way, 2 economists created this new model of looking at that. And it's called the Heckscher-Ohlin model, the model of factor endowment. And this model kind of goes into how different countries are endowed with these resources, endowed with labor, endowed with capital, endowed with land. How much are they endowed with? And what they showed is a country's comparative advantage is linked to its factor endowment. If a country has more labor, then certain activities that require higher labor intensity are cheaper for that country to do because they're giving up less to do it, right? Versus a country that maybe has a high intense, that has a smaller pool of laborers that they don't want to do those higher intense labor goods because there's other higher value activities they could be doing. And by taking a worker away from that higher value activity toward the lower value activity, it costs so much more, that opportunity cost of not having that other good, right? And so I think what's interesting is if countries that have a higher endowment focus on those things that they can produce cheaper because of that endowment, They're doing it cheaper than other countries. And then those countries trade with each other. What happens is they both end up benefiting because one country is getting resources for cheaper than it would cost for them to do it on their own, as measured by where are we taking resources from to apply to making this good and service.
Yeah.
Yeah, go ahead.
So labor, you're saying like labor is a resource. And so the same way you can think of it as any resource. So Mexico produces avocados and they export the most avocados because they're the best at doing that. And same goes with labor and different things that countries specialize in these different things because they're the best at doing that and it's the best price for them. And that's why they're able to do it the most efficiently, and that's why they have the most exports. And
that's it. Yeah, I mean, I think what's interesting is I have that exact example written down. Is there's an example of labor-intensive work exported to China. We've all heard all of our manufacturing capacity has gone to China. That's why you expected that our manufacturing output's down 40% since 1983, right? It's actually up 133%. It's more than doubled.
Oh well.
Okay, and that's because
ours.
Ours has more than doubled.
The number, I guess, 40% down?
Yes. I'm using the example. Everybody thinks all of our manufacturing jobs have been shipped to China, but what's happened is all of our labor-intensive factory jobs have been shipped to China because they have a lot of labor. So they're not pulling their labor from some other high-value source that's more available, so there's less opportunity cost. So now we're not using our laborers for that. What are we using our laborers for? Something else. Our unemployment rate's 4.2%. Yeah. So they're being used somewhere else where they're more productive. They're giving up less by switching jobs and making something at lower value. The other example I had was what you just said as far as land use. Some climate conditions are just better for agriculture. We benefit from that here in the U.S. We have a ton of agricultural exports, and that's because of different waterways, different climates, different soil quality and stuff like that help us. But then you talked about Mexico and avocados. They have certain heat and humidity and weather conditions that allow for avocados. Imagine if we wanted to take some of our land and some of our labor and dedicate that to making avocados. It would be tough. The soil's not right for it. We're going to lose a ton of yield because the temperature conditions aren't right. And we're going to have to do a lot of stuff and add a whole bunch of extra resources to do that and get less out of it. So we're better off allocating that land to, say, drilling for oil or raising cattle or making cotton and some of these other agriculture exports we have in the U.S. versus making something that's tough for us to do that we would have to give up a lot for by way of what we could have produced with those resources. And so I think that's what's interesting with trade, and that's what people are missing in this discussion is that stop thinking of our economy as something where we want to maximize the number of jobs. We don't want to do that. We want to maximize the efficiency of our workforce, which means keeping everyone employed, but also making sure those employed are not employed in low value activities where they could be doing something more. I mean, think about where we would be if we said, hey, there is a lot of young adult men that are employed taking telegrams back and forth among businesses. Therefore, we need to outlaw the telephone because those people will be out of a job. Okay, there are no buttons allowed in elevators or all the elevator operators will be out of a job. That's not how we think, right? But all of a sudden, when we could do things with less resources and less costs, and we use that for other countries, we think we're losing. No, we're just allowing their resources to do what's good because they have so much of it. And we're focusing on what we do well. And by the way, what's our factor endowment in the US? It's capital. It's the tools and equipment. We have become so productive as a workforce. We have all kinds of specialized equipment and complex machinery and tools that allow us, our workers, to be so much more productive, which is why we don't want them doing other things where they're not as productive and have low value activity. So that's my last graph, Arish, is it's a graph of two lines. And the purple line, and this is since January 31st, 1983, the purple line is an index of U.S. industrial production, manufacturing since 1983. So this is manufacturing output, real manufacturing output adjusted for inflation. And this is the number of people employed in manufacturing over that same time period. So what you see is we have more than doubled our output, but we have decreased the resources, the labor resources that we are using to do it by 15%. And so really the thing about manufacturing in the US is not that it's gone bye-bye, it's that it's become increasingly productive because we are so good at using the resources that we've been endowed with, equipment, capital, and knowledge, that we are able to achieve these outcomes.
I mean, that's such an interesting way to look at it that I don't think anyone really talks about. It's just like these jobs are gone. We're outsourcing these jobs, bring them back. It sounds good to say that on paper. Like, we have all these jobs that we're outsourcing. Let's bring them back. But we're outsourcing them for a reason. We're able to be more productive. That's not a resource that we want to be, I guess, spending or using, because we can use it better in a different way. And this shows exactly that. So
That's right. Yeah, I mean, think about if you're building a house or you're digging a ditch, right? You can dig a ditch with one man and one piece of Caterpillar equipment, or we can create a ton of jobs and outlaw Caterpillar equipment and have 100 guys dig a ditch.
Yeah.
We've created jobs. Is that the right way to do it? I don't think so. And by the way, I said it before, our unemployment rate's 4.2%. If you look at our prime age working population, so people from 25 to 59, and the percentage of those people that are working and in the labor force, it's at new record highs. So where are all these new jobs coming from? Where is the labor resource going to come from to take these jobs that are being brought back? They're not there. They're somewhere else, applying their jobs somewhere else for higher value. That's the way the markets and the economy is supposed to work. And that's how we increase global production, by making more efficient use of our resources.
Certainly. But I mean, if I had to sum it up in 4 words, globalization good, tariff bad, but trade is good.
Trade
is good. Yeah.
Right. And get back to the original thing of economies. Trade and transactions are mutually beneficial. They must be, because both parties are agreeing to it.
Mm-hmm.
Okay.
Exactly.
And so, it's not just like we're trading and this is some decision being made somewhere else. I mean, consumers are choosing to buy the cheaper goods. Consumers are choosing to buy the things that require less resources because it's cheaper. They have to spend less of their own resources to get it. Why wouldn't they? And that is ultimately good for everyone.
Yeah. So ultimately, do you think it's inevitable that we go back to, and I mean, you obviously can't predict the administration and next decisions and things like that, but I mean, the benefits of globalization obviously far outweigh the cons, if whatever they might be.
And there are, people do lose their jobs.
Yeah.
There is that period where people have to be retrained and reassigned to work, and these do have consequences. I certainly don't want to blow past that. But economists look at the net impact across the entire economy. And yes, when a factory shuts down and 300 people lose their jobs, that is bad for those 300 people. But now 330 million people are receiving goods, the same goods and services, at a lower cost to them. And that allows them to go and do other things with their money and spend more on other items, just the same as it allows our productive resources to be better allocated to other productive uses.
Yeah. So I want to kind of tie a knot on this and bring it back to the market and economy. I know we're running a little long here, but so we've seen the stock market rebound. We've kind of come back. We talked about that. What are and on the tariff front, I feel like that can has just been kicked down the road a couple times. Why are we not going to have the same issue in 90 days or whenever this is going to come back up? What are kind of economists seeing or analysts seeing that's different this time? Is the looming threat of tariffs and what we have with trade still something? I guess those fears have been mitigated to an extent, or can you kind of touch on that?
Yeah, I'll tell you how we're kind of viewing it. So economists and strategists, whenever the initial tariffs were announced, 60, 70% tariffs, 135% on China, steel and aluminum with Canada and Mexico, all this stuff, probability of recession was going up to 50, 60%. They're dropping their price targets, dropping GDP targets. IMF was dropping their GDP targets, right? And then all those tariffs were either delayed and very drastically cut and reduced, including later on China as well. So since then, all those GDP forecasts, calls for recession, have pretty much gone away. And people are saying, okay, we can avoid recession now. The problem is that those 10% tariffs still exist, and 30% tariff still exists on China until this 90 days is over, to your point. And so, yes, I still think that would be a net negative for the economy, as tariffs make things more expensive and you get less of it. So it is just a net negative, and we should allow trade to continue happening. But I think what's really happened here with the administration, just kind of my own view, is that they kind of, I think they were surprised, right? I think Trump had a lot of support for tariffs and a lot of support for bringing back manufacturing in the U.S., which I think, obviously, in my opinion, is misguided. But there's a lot of people who feel that way, and I think they were genuinely surprised by the market reaction and by, not just the stock market. It was corporate leaders, it was business people, it was people within the administration that were trying to talk Trump out of it. And I think people have become so scarred by this experiment that really what they're trying to do is turn away from it. So actually what I would expect is that these 10% tariffs don't hold, and that this 90-day pause really is just kind of, consistent with their cadence of reversing a lot of their trade policy and kind of learning their lesson on it. And I think what a really awesome outcome would be is if Trump uses these threats as a way to renegotiate some of our trade deals and work down existing tariffs and other barriers that would then increase trade across the globe. I think that would be an amazing outcome. And it sounds like so far that is the direction the Trump administration is going, which is, I think, a wonderful pivot by them. And so I hope that continues, and that would be good for U.S. growth, global growth, et cetera, right? I mean, places like India still have high tariffs on us that he's trying to negotiate. There certainly are unfair practices that China commits that we need to address. But overall, I think the administration is seeing the market and the economy and voters don't want tariffs. They don't want things to be more expensive. They kind of like trade. There's a reason why things exist the way they are. And looks like that's the direction they're going. So I think we're past kind of the worst of it, honestly.
Yeah. Well, no, I mean, this has been insanely insightful for myself. I'm sure the listeners are going to take a ton out of it. Any last pieces you wanted to hit on before we wrap? I feel like that was good. We hit a lot.
I think that was a really good discussion. I encourage a lot of people to read some of the economic pieces on trade and that theory, instead of just thinking, someone else took my job, or someone else is doing this, or we're buying this from someone else when we could have bought domestically. That's not really the right way to think. We all have a trade deficit with Kroger and Walmart, right? Yeah. And guess what? The people that sign my paycheck have a trade deficit with me, and we all have trade deficits with each other, and that's what makes the world go round. And we need to, encourage that. It's a market force at the end of the day. So if you're pro free markets, you should be pro free trade.
Let's end it on that. That was huge. You're spitting right there. that was some good stuff. Yeah, I love it. Well, appreciate you as always, Jeff. And tune in for the next episode next month. Oh, the only other thing I was going to say, I think we're going to get this out right before, or maybe it might be too late, but you're hosting a webinar on June 3rd. So if this gets out before then, I think it should be right around that time. If you're able to join, we'll have the info in the description below. So if you want to hear more of this, I know you'll probably have some more graphs and different things you're talking about there.
Several.
So,
Several. Yes.
Love it.
Thank you.
Love it. All right, Jeff. Appreciate you.
All right. Thank you.
Thank you for listening to our podcast. Remember, the views expressed are not necessarily those of Beam Wealth Advisors. All content is for educational purposes only and should not be construed as an endorsement of any third party or their views, or as a solicitation or offer to sell securities or provide investment, tax, legal, or consulting services. We believe the information presented to be reliable, but it is not guaranteed for accuracy or completeness. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not a guarantee of future results. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request or at the SEC's Investment Advisor Public Disclosure website, advisorinfo.sec.gov.